I hate banks. Most wealthy families don't like to use banks, and we're going to talk about how you can buy real estate intergenerationally with your family without using banks. So, I'm Paul Morrow. Let's get to it. In chapter 6 of my book on Smart Financial Grandparenting, we're going to talk about the best use of the bank of grandpa. If you're lucky and you have a big family, right, you need to start thinking about intergenerational wealth and the benefits of using the bank of grandpa. Now, if you have a grandparent, by the way, comment, reach out to us. If you want to get a free copy of this book, we'll email one to you. You can give it to your grandparents. If you're a grandparent, we're happy to send it to you, and you can read it and then talk to your children and grandchildren. Because the cost of a simple loan, let me just remind you, a $100,000 loan from a bank over 30 years at 6% costs $140,000 in interest. That means for every $100,000, you end up paying $240,000. Now, the choice is really simple. If your family has some resources and you're a close family, interfamily loans are awesome for building multi-generational wealth. Also, you have to ask yourself, would you rather $140,000 of interest get paid to a bank or to your grandparents? Let's talk about this. I'll do a real example for you today of a grandparent that we work with that helped their grandson buy a $520,000 property. Now it's 2025. So I know $520,000 sounds like a lot of money in different parts of the country, but I'm speaking to you from New England, and this was an average home price. The average home price in America is about 400 and something thousand now, but this one was 520. And in order to get that home, that young fella had to put down $100,000. So where did he get the $100,000? Well, he could have worked and saved. He was 24 years old. He could save up for 10 years. By the time he saved up that money, that $500,000 house would be $820,000. That's the normal appreciation rate on metropolitan areas in New England, California, and other big metros. It's about 5%. It's up from 4%. So a $520,000 house would be $820,000, and he would still be short on the deposit. So let's fix it. And let's fix it by using the bank of grandpa. Really simple. Let's just imagine for a second that you go to meet with your financial team. And by the way, here's my usual disclaimer. Before you buy or sell or trade or lease, please meet with and take the advice of your personal financial advisor, your lawyer, your CPA. Get everybody together on this idea. And to do an interfamily transaction, you need them all. I'm very fond of the attorneys that work in this area for family estate planning and the accountants that are smart and understand the value of owing grandpa interest and the value of grandpa maybe forgiving the interest if he wants to. But let's just run through the example. This $420,000 mortgage on a $520,000 property was what the grandson could carry after grandpa gave him the deposit. Grandpa gave him $100,000. He had $100,000 sitting in the local bank, making him 3 or 4%. Instead, he invested in a property with his grandson, a $520,000. Now, in this particular case, it's in actually the greater Worcester, Massachusetts area, and this was a two-family. And in that two-family, a side-by-side two-family home, each one of those units was generating about $1,900 a month in rent. So that means that when the young fellow got his mortgage on his first piece of real estate, grandpa put down $100,000. They got a conventional mortgage for $420,000. The conventional mortgage payment was about $2,860 a month. But the secondary unit was paying $1,900. So the young fellow got in there and he was paying really only about half of the cost of the mortgage because his tenant was paying. So this was a great way to get started in real estate. Grandpa had the security of a loan to his grandson. Now, some families are more formal than others. They do inter-family loan documents. You can even close on the transaction. And if you want to give a second mortgage deed to your grandpa in case something bad happens, right, and grandpa gets his money back, you can do that to secure him on the property, right? That's all fine, right? That's done with your lawyer. But this transaction went like greased lightning. They closed, they got a tenant in. Now, what's the plan for this family? Let's go forward 10 years. This young fellow will be 34 years old, just out of college, really starting to make money now. That single piece of real estate, that $520,000 initial piece of real estate, will be worth, without too much exaggeration, in the $800,000 range. He will have $300,000 in embedded equity. What are the choices? You're 34 years old. Your grandpa now is not 70, he's 80. Perhaps grandpa needs that money. Maybe he needs it for healthcare or some other reasons. Very simple for him to do a refinance at 34. He's got more income. He's got credit. You helped him to get established. He could refi. He could take $100,000 out tax-free and pay off grandpa. Maybe grandpa doesn't want that. Maybe grandpa would prefer to get payments, to get income. I don't know what the interest rates are going to be in the next 10 years, but for grandpa to be able to get 6% paid by his grandson might be a very attractive rate. Now, if grandpa's affluent, grandpa also has the ability to forgive the interest annually and even to forgive the loan partially over time. He can forgive a portion of that loan over the next 10 years under the gift tax exclusion. And at the end of 10 years, perhaps his grandson owes him nothing. So this is a great use of intergenerational family wealth. Now, in the state that I'm talking about, there's also another factor here, which is the death tax for grandma and grandpa at the end of their lives. So one of the techniques for reducing the death tax in a state like New Jersey, Massachusetts, New York, California, Colorado, one of the ways to reduce that tax is to give money during your lifetime. So giving money during your lifetime reduces the estate of grandpa. He doesn't pay tax on that money. And guess what? At the end of his life, the family doesn't pay tax on that money. So it might be to that family's advantage for grandpa not to get back the money, or for grandpa to assign the note to another grandchild, so that, in fact, the profits on this real estate transaction can go to perhaps his next grandchild. So there's a lot of techniques that can be used to take that single investment that grandpa can make at a time in his life when he's got the liquidity, and to help newly launched children and grandchildren through their first transaction. I know it's scary, and I know it's frightening to buy your first piece of real estate, and I know it's even more frightening, right, to go into the real estate market in 2025 because the numbers are 10x what it was years ago. But to get into a piece of property early is better than waiting. It's just like the movie, It's a Wonderful Life with Jimmy Stewart, where he's sitting there and he's talking to the real estate developer, and the Grinch that lives down the road, Mr. Potter, says, well, they can save up and they can wait. Well, by the time people save up the deposit, the real estate's appreciated so much, they're still short, and their kids have grown up. And maybe this young man at 24 is engaged, and maybe he and his wife will live in that house for their first, real estate transaction. There's so many good reasons to help your family intergenerationally and enrich your kids and not enrich the bank. And when I say that we don't like enriching banks, this is a classic wealthy family transaction. Keep the wealth circulating in the family by making interest payments to other members of the family, or forgiving those interest payments, so that you're not enriching the banking system. So at the end of this, by the way, if you stay to the end of this video, I'll be happy to download to you. If you reach out to us, give us some comments, click on the link in the captions below here, and we can send you a free copy of Smart Financial Grandparenting, answer some questions about how you actually structure a transaction like this. We have a 6-point sort of checklist on inter-family loans and transactions. This is a tremendous way to build wealth for the long term, because keeping your money in your family is just part of the art of being smart.